best just to go back a little bit and look at the key milestones. The first one is in 1996, when the JSE actually moved from an open outcry system to JET, electronic trading. And that's really the platform that has allowed the developments to take place today. The second key milestone is in 2005, when they allowed for the first time direct market access. And that meant that a client of a broker for the first time could trade directly onto the exchange without anyone touching the order. It gets routed via the broker, and the broker takes responsibility for it, but they effectively hit the button themselves. In terms of some of the terminology which is important, the first one, and we've kind of covered now, direct market access. The second one is algorithmic trading. Algorithmic trading really it provides the tools around direct market access. For instance, if you as a client have 100,000 Anglos to buy, you can put in 5,000 at 200, 5,000 at 199, etc. The tools, algorithmic provide the tools to create a strategy, and is done automatically for you. Now, these strategies have obviously developed over time and have now become incredibly complex and can meet most needs for any external investor. And they're broken down into effectively 5 key components. One are time-based strategies. These are the ones that take a big order, slice them into time slots, and work them over the day, and they're referred to as things like TWAP or VWAP. The second one are volume-based strategies. These are the ones that look at the volume taking place in the market and then act accordingly. In the early days, these strategies actually gave algos a bit of a bad name, because you can imagine you've got a situation where 5 people are trying to buy 30% of the market, and you get these volatile swings. The third one we refer to as kind of time-sensitive, yet urgent, in the sense that someone wants to get the order done quickly, but they don't want to have a material impact on the market. And those are normally like what we refer to as implementation for strategies. The fourth one would be pairs, where you want to buy one stock and sell another stock. And the fifth one would be liquidity seeking strategies, whereby you don't really want to be in the market, but if something's happening, you want to be involved. And they refer to things like hidden or sniper or float and grab, all these colorful names. Now, if you're going to use these strategies, I mean, one of the key things is obviously choosing a platform and a provider in doing so. Now, the first thing you need to look for is a platform that is reliable, user-friendly, and has low latency. And what I mean by low latency is that what you're seeing is real time and it's happening on the market. Also, you need some type of support, because this all happens in milliseconds. If you hit the wrong button or something goes wrong, you want someone overwatching it that can stop it. The second thing to look for is to choose the correct strategy for the objective you're trying to achieve. Now, what is important here are 3 key things. One is the size of the order that you have. The second thing is the time, the urgency in terms of execution, and the third thing is the liquidity in the market. As you can appreciate, if you want to buy 100 Anglos, so it's a small order in a big market and in a liquid market, and you want to do it quickly, it's easy. But if you want to buy an illiquid share in a large amount, it needs to be handled very differently. Now, so choose the strategy that meets your needs. And then you need to make sure you're using algos and an algo provider that really understands the microstructure of the South African market. Because obviously there's a lot of nuances. We have auctions, the closing auction being important, we have a midday auction. We have influences on our market, for instance, when the US market opens or the UK market opens, and obviously there's changes depending on summertime or not. You need to understand the spread. So you want someone that really can analyze and appreciate the microstructure and then adapt the strategies around that. And that's where you're going to get best execution. And the proof really is in the pudding. I mean, we have what we refer to as transaction cost analysis, and that'll tell you how your order has performed using that strategy in the market.